the worst day in American financial history. The stock market dropped 22.6% in a single day. In one day. This is the story of how the richest country in the world lost $500 billion before dinner. To understand Black Monday, we need to go back to the years before it. 1982 to 1987. The American stock market had been on the greatest bull run in history. Every year, prices went up. Every year, people made more money. Everyone felt invincible. Investors were borrowing money to buy stocks. Companies were buying other companies. Wall Street was partying like it would never end. But underneath all of it, something was very wrong. Stock prices had grown way faster than actual company profits. The market was a balloon, and balloons pop. The week before Black Monday, cracks started appearing. Wednesday, Thursday, Friday. The market dropped several percent each day. People were nervous, but nobody panicked. Not yet. Then came the weekend, and over that weekend, two things happened that changed everything. First, Iran attacked an American oil tanker. Tensions in the Middle East exploded. Second, the US Treasury Secretary went on television and basically said the dollar was going to weaken. Investors around the world read both headlines, and they decided to sell. Monday morning, October 19th, 1987. Markets in Hong Kong had already crashed overnight. London opened, crashed. By the time Wall Street opened at 9:30 a.m., the phones were ringing off the hook. Everyone wanted to sell at the same time, all at once. But here's what made Black Monday different from every crash before it. A new technology. Computer trading. For the first time in history, Wall Street firms had programmed computers to automatically sell stocks if prices dropped below a certain level. It was supposed to protect them. Instead, it created a death spiral. Prices dropped, computers sold. More selling pushed prices lower, computers sold again. Lower prices, more computers sold. Nobody was making decisions anymore. The machines were running the crash. By noon, the Dow Jones had fallen over 200 points. Traders were screaming. Phone lines were overwhelmed. Some brokers simply stopped answering the phone. People trying to sell their stocks couldn't get through to anyone. The system was breaking down in real time. One fund manager described that day like this. He said it felt like the financial system was just shutting off, like someone was pulling the plug on the entire economy. By the closing bell at 4 p.m., the Dow Jones had fallen 508 points, 22.6% gone. In one day. $500 billion in wealth wiped out. People lost their life savings. Pension funds collapsed. Companies that were worth hundreds of millions in the morning were worth almost nothing by evening. And the terrifying part? Nobody fully understood why it happened while it was happening. The Federal Reserve didn't know. The White House didn't know. The banks didn't know. That night, the chairman of the Federal Reserve, Alan Greenspan, released one single sentence. It said the Federal Reserve was ready to provide liquidity to support the economy. One sentence. That was it. The next morning, markets stabilized, then slowly recovered. Within 2 years, the Dow Jones had fully recovered all its losses. But the damage to people's trust, to their savings, to their retirement accounts, that took much longer to heal. And here's the lesson that Wall Street learned, or was supposed to learn, from Black Monday. When everyone is making money, when stocks only go up, when everyone feels invincible, that is exactly when you should be the most afraid. Because markets don't crash when things look bad. They crash when things look perfect. Black Monday didn't happen because of a war, or a famine, or a scandal. It happened because everyone was too confident. The computers just pulled the trigger. $500 billion, one day. The worst day in American financial history. If you want to know about the next great crash, 2008, the one that actually broke the world, comment below. That story is even darker.